The S&P 500, as we mentioned, crossing above 5,200 for the first time, holding above that level. Joining us now is Saira Malik, Chief Investment Officer at Nuveen. Saira, it's great to see you. So we do have Fed basically more of the same in terms of its message. Same 3 anticipated rate cuts. Market seems fine with the Fed sort of stepping aside. What were the key things you would pull out to observe?
Yeah, it's great to see you. I think that there's 3 outcomes that the markets like about the Fed meeting. That's the economic growth upgrade to projections, also the dot plot that didn't change, and Powell did not sound incrementally hawkish on inflation. But under the hood, let's first look at the dot plot. That is teetering on the brink of moving to just 2 rate cuts this year. I think that's where we likely could end up. And also with inflation, Powell sticking to his 2% target. The question is, when will we reach that? I think it could be years rather than months before we get to that 2% target. So second is, where does the market go from here? Well, first of all, there's a lot of FOMO, cash, trillions of dollars of cash on the sidelines that's been looking for how to get back into this market. And I think secondarily, for the S&P to continue to move higher than 5,200, we need this rally to continue to broaden. That's where I'm more of a skeptic. Just looking at earnings growth for 2024, tech by itself, earnings growth is expected to be about 20%. The rest of the S&P about 5% earnings growth. This strong economy needs to translate to the rest of the non-tech S&P 500 to boost that earnings growth. I think that's how the market will sustainably broaden from here.
Well, you said you're somewhat skeptical that that's going to kick in right away. Does that suggest the risk reward at this level for the market in general is not that great?
I mean, I think it's going to be tough to find that catalyst to have the markets move higher. If you look at the non-tech portion of the S&P 500, they are dealing with this sticky inflation. Wage inflation also is impacting their margins. Also, on the revenue growth side, they just don't have the structural tailwinds, such as AI and the demand to increase productivity that's benefiting tech companies. The rest of the S&P doesn't have that. And you can see that in the material sector, energy sector, and healthcare sectors, which are under pressure in terms of earnings growth. And those are large drivers of the rest of the S&P.
You know, you mentioned that certainly there are trillions of dollars in cash. You know, a fair portion of that is retail investors. But if you're an investor and you're involved at all in the equity markets, hasn't the market itself kind of kept you involved and raised your exposure and kind of allowed you to have both at once, have the cash cushion, a little bit of income, and then be able to, support whatever equity risk you want to take?
I think we are hearing from our clients that many of them are rebalancing somewhat out of equities because of the huge run that it's had, and they're just trying to be disciplined in terms of diversification. I think a lot of that cash, when it comes back into the markets, what it should be looking at is fixed income. High yield fixed income from taxable to munis. You can lock in yields in the high single digits, even sometimes in the double digits, that you haven't seen in years. It should be a little bit more resilient because we still do expect 2 to 3 rate cuts this year. I think that's an area where you can get out of cash and out-earn the 5% that you can earn in cash and get more returns in fixed income.
And I guess, raises the question about the rest of the world. There has been global confirmation of this bull market. You've seen some strong markets elsewhere, but there's a lot of catch up to be done. If you think that we need, so to speak, the market to broaden away from big cap U.S. tech here, that would also suggest the rest of the market, the world would be less disadvantaged.
Well, first looking at Europe, I think Europe is in the disadvantaged camp. They have a similar inflation problem, but they just don't have the economic growth that the U.S. has because the U.S. is exceptional when it comes to technology and its leadership. China, of course, maybe some green shoots there, but still property issues and other issues in terms of China getting back to its historical growth rate. Japan looks promising. Japan GDP growth. The consumer in Japan, I think Japan is an area that investors can look at. And just thinking about the world on a global basis this year, something else to consider since it's already March is that we're going to have 77 elections this year, 60% of GDP. Normally that does cause more volatility for the markets. I think it's going to be a little bit more than noise this year because the less predictable the election outcomes are, the more volatile the markets are. So that'll be, and with the misinformation, with artificial intelligence, I think that could add volatility to the markets as we sit at 5,200 on the S&P.